right. So my AI clone, the digital version of me you can chat with, went and promised someone I do intros for my podcast episodes. At first I was like, great, another thing on my to-do list. But then it hit me. If my AI clone made the promise, my AI clone should do the work. So here it is, straight from the machine. In this episode, I sit down with James of Arc about venture capital. James doesn't mess around. He lays out the entire life cycle, from the storytelling you need at the seed stage to the hard metrics that are non-negotiable by Series A. We talk about why most founders shouldn't even try to raise capital, and for those who do, why they're probably going to fail. I get into some of the hard lessons from my time with Wasabi Wallet, like the time I gave away half the company and whether we should have taken the money when everyone was knocking on our door. We debate if my new project, the Longevity World Cup, is even a venture backable business or just a game I built for myself. Finally, we zoom out to an even bigger arena, building new cities. James is all in on this with his project ARC. He makes the case that our current systems of governance are brittle and won't survive the collision of AI, Bitcoin, and radical life extension. It's a high-stakes, contrarian view on where the world is headed and why building from the ground up is not just an option, but a necessity. No fluff, just the mechanics of very big games.
It's all good. I ate some coffee beans. That's what I did as my alternative. I'm pretty sure that's probably got better health benefits than drinking the filtered coffee.
Mm-hmm. I have no idea.
I expect so. It should be on the Longevity World Cup. There should be an A/B test of people that just eat coffee beans and those that drink coffee. We need scale, right? And then we'll start to be sort of like statistically significant sort of like results for that, right? There's small things like that.
I was thinking about that how much the data is useful that it is generating, because even the things that every single person does in the Longevity World Cup, even the things between their cross-biological aging clocks, is that even a useful data? Because they are not going to measure the same biological aging clocks the same day. So how good are the correlations? Well, I don't know. I will leave the researchers to figure that out.
Well, yeah, I think the data is still worth capturing, right? And I think that like it's more like at the minute, like I think you can use it as like, I think like doing statistical analysis on it is almost maybe not useful at the point of hundreds of people, right? It's more like you can look at the winners and you can understand their protocols, and you can maybe just like, again, like use just more of like a judgment-based call to like look at what there is. Maybe you can see some patterns across them. But I guess, yeah, once you've maybe got, if you've got millions of people that are like sharing protocols, you should then be able to start correlating like, okay, well, the people that eat coffee beans as opposed to drinking coffee are on average living 3 years longer, right? Like it should be possible at scale, right?
Yeah, so people upload their blood test results with a lot more things than just the biological aging clock. So it's kind of like an open source, publicly accessible UK biobank, right?
Yeah.
But, you know, I am more capitalistic than caring about these side effects. Perhaps it's going to be useful for someone. Speaking of capitalism, James of ARC, let me tell you why I invited you here today.
Go for it.
I run a company for 10 years. I was always suspecting that there is a game that I'm not aware of. There is something going on, and I've read many books about running companies, biographies of of people like Elon or Jobs or Netflix or whatnot, right? And of course there is a game of raising capital, of scaling to the next level. Watched so many things about blitzscaling, read the book The Blitzscaling. Still, things didn't quite made like a perfect coherent sense to me until I sit in your presentation about how to raise capital, how to raise money. And that was a big aha moment for me. For people who even if you don't want to raise money, right? You should be still aware of this game is being played because perhaps your competitors are playing this game, right? In my case, it might have actually saved my company. My product survived as an open source non-profit thing, but if I would have known and would have raised capital in a way that's how you described, then perhaps we could have built like a very reputable privacy software that would have been really hard to attack on a legal front. The first thing that I want to know is what's this game about?
I mean, the game that you're specifically alluding to in the example, right, was the game of raising capital for technology companies that are trying to go and do something new in the world, where there's an element of risk that maybe no one wants that new thing. But if you are correct, and people do want this new thing, it's typically a brand new market opportunity across the entire world. And that's a very valuable opportunity. And there's therefore a race to go and be the solution across that entire world. It's a competitive race against other people, which is why you raise capital. Because even if you are profitable on day one, you're not profitable to the extent that you can, simultaneously launch 100 territories and go and capture that opportunity. Whereas someone else will if they have the capital to do that, right? So that's the game we're sort of talking about, which is like how do you go and win these like venture opportunities, these like brand new, huge global opportunities, and how you use capital to sort of like do that, right? That's a very sort of specific game. I think
let's contrast. What are we not talking about here?
Just an example, right? Like if you are opening a coffee shop on your local street, there's probably already a coffee shop on your local street. There isn't like the same sort of like market risk. There's not the same innovation. There's not sort of like breakthrough or, new thing that you're doing kind of in the world. You're still doing something new, right? Like you are creating a new brand, and you're leaving your mark, and you're probably still doing something very valuable. If you have customers that are coming and enjoying your coffee, then that's like absolutely valuable and a worthy thing for you to sort of like to do. But I guess like the element of original, new, uniqueness, insight, breakthrough, never been seen before is quite limited, right? And therefore, like the opportunity is sort of like fairly limited in that regard as well. Now, you can still build a very successful coffee business, and you could open up more coffee sites, etc. But that's a very, very different type of business, and that type of business tends to get funded by private equity, like as an example, which is a different sort of like class of capital than venture capital. Private equity is very, very broad kind of like term. The type of private equity that would be focused on, for example, investing in food and beverage outlets, retail, this kind of like stuff would be someone that, again, you would still have a private equity fund that is specialized in doing these things. But they might do SPVs on a deal by deal basis, but like they would not be expecting the kind of like the median outcome of an investment to be zero, because the risk is very, very different, right? It's like you've opened a coffee shop, and it's making money, and you've got customers coming in, and you want to open 10 more. And you've got a model already that you proved, and actually going and opening these 10s here, it's not the same risk as you're building some sort of like new piece of technology, and you need to access venture capital, because actually even through the first years of your business, like the median outcome will likely be zero for what you are sort of like doing. So yeah, so I mean, and that's maybe like too detailed or too broad, but like just basically like the number of companies which are venture backable companies is an extremely small percentage of global companies. So it's like very, very it's the vast majority of things are not the kind of the game that we were talking about the other day, right? Like it's like, less than 1 in 1,000 companies are truly suitable for kind of like venture, kind of like capital,
All right, let's bridge it a little bit. Are you familiar with the McDonald's story? That the McDonald's brothers created the first McDonald's, and then Jim Croc came a couple of years later, and he basically made the entire thing global, and kind of like kicked out the McDonald's brothers, and I'm not sure. Are we talking about this kind of business with his innovations? Right? What was his innovation? That you're creating franchises. You're giving a lot of control for the people who are running the places, and then what McDonald's is doing is that it is, well, first of all, quality standards, right? And the other is that buying the property and renting them out to the people who are running it, right? The McDonald's shop, not owners, but franchise managers.
I don't know like what the global kind of like McDonald's is kind of like worth, right? But clearly, if you invested in the first round of McDonald's and you held until the end, like you've done very, very well, right? And you have like a venture-like return. But it's a different type of business, and it's not a typical business that kind of like venture capital has traditionally been, kind of around to do. Like again, and like,
could it be that it is different now, but it was the same kind at the point when they were working on it, right? Because then the solution was new. Now it's not new everywhere. There are franchises everywhere.
I don't know who was the first franchise, but I expect that McDonald's, I don't know, maybe McDonald's invented the franchise model.
Netflix kind of invented the subscription model, right? And now subscription is not really new. You can copy how other people are doing it, but Netflix was the first that it actually had a need for the subscription model.
Sure. And this is, you can abstract that level, right? Like basically like anything new that like drives like efficiency into an activity, a process, a system of some description is a technology, right? Like language is a technology, right? As just like one example. And so in one regard, like, again, venture in like backing sort of like unproven technologies, like technologies, it's a very, very broad kind of like term. And actually, like if you to do some software eating the world, right? Actually, how technology has just been like even like more stereotypical technology, and it being like literally like lines of code has just been like taking over more and more industries and infusing. But I guess your reference point here is that there was something kind of like new, and it was being sort of like done for the kind of like the first time, like Netflix launched a business model of like subscription as a service, right? Again, I think that I don't think it was when Netflix that was the kind of like the first there. I think like a lot of B2B SaaS have been around for quite some time, but maybe you're applying a similar business model to a different.
It wasn't SaaS. It was a DVD subscription, right?
Sure.
They are posting the DVDs and
yeah. Is that how Netflix started as well? The blockbuster type of all idea, the kind of like actually insane how these things start, right? But yeah, so I think these are all, again, it's like I said it in the talk that I gave as well, right? That it's like there's no hard and fast rule, and everything is on like a continuum. And we're going to try and talk about a set of patterns and a process for like a median stereotypical case sort of in this, right? But there's exceptions all over the place, right? Mm-hmm. And but again, if you're looking like, and I think venture capital has also strayed away from like what it does best. I think if you actually look at the AI stuff, I think it's a good example of like what venture capital is like should be doing, right? Where it's like, okay, you know what? We could have artificial general intelligence, right? And 10 years ago, we've been saying we could have that for 50 years. And this is a great venture asset class where you find an incredible team that have a hypothesis or work that they want to do, and they feel that they can build a breakthrough, and that if they're able to build AGI, that is clearly $1 trillion opportunity, right? But the likelihood of them doing it is basically zero. And this is like a great venture opportunity, right? Where venture capital takes these like obscene risks to try and get these absurd rewards if you do it sort of like correctly, right? And that's traditional, right? It doesn't have to just be software though, right? Again, like it's like, Teslas and SpaceX and all these guys are sort of like considered as well. And they're very much in the hardware sort of like world, right? But a lot of original tech is in the hardware.
Okay, so what you're trying to say is that it has to be a big problem that haven't been solved before.
Traditionally, yes, but it's like these days, like most venture capital doesn't take very much risk. It would be better to be renamed like lack of venture capital. Like really, it's like most venture capital, a lot of it's just chasing like very safe, like B2B SaaS companies that are broadly already proven, and they could basically be funded by private equity. And some of them do if their growth rates aren't as high as they kind of like need to be for venture capital. But yeah, there's like loads of things. Everything's on a continuum, all this broad sort of stuff. I do think your McDonald's example is an interesting example, right? It was like, okay, well, we created a new business model, maybe, or whoever invented like the first franchise. And I think that venture capital is, again, like I'm in the business not of, of building, let's say, cities. And I'd say that if you're looking at it as like a very narrow like software lens,
let's say cities. No, it is cities. You are in the business of building cities,
or maybe but there's or worlds, or let's see. But there's maybe we're going to end up building a lot of software as well. But it's not like it's not the most important part of what we're doing. But it's like very much for me a sort of like a venture asset class, particularly at the kind of like the earliest stage, where just like there's clearly a lot of risk, right? Like there's for every 1,000 people that think that they should build a city, maybe one person does. And if you're able to to go from nothing to a Singapore is worth tens of trillions of dollars. It's the if it had a market cap, it would be the largest company that's ever been created. And that's like a venture profile. It's like, okay, extremely high risk, like most likely to fail, most likely to get nowhere. But if you actually succeed, then like, okay, this is going to be world changing and extremely economically valuable as a byproduct of sort of like being sort of like world changing.
So it's actually creating a bit of a contradiction for me, because the second takeaway that I had from your talk is that the end goal is an IPO. And without going too much into what your plans are about with Arc and creating a city or a world, that's not the end goal there, is there?
I think the point is that like for any company that you're building, regardless of what you're building, whether it's McDonald's, whether it's Netflix, whether it's SpaceX, and however beautiful the story is that you tell, or the product that you think you're dreaming of building and the vision that you tell, all it is a story for a set of numbers that broadly have to go up and to the right over time. And all of them are just competing for capital that is limited and finite and has options of where it goes. And so if you need capital, it's sort of, again, it's just a narrative. Like, I want to build a city. Okay, great. We're going to use the capital to build a city. But basically for us to keep that capital and to keep on getting that capital in the future, we have to outperform on a risk reward adjusted sort of like curve, right? Like we have to basically present a higher reward for the level of risk that those investors feel that they're taking, right? And so if we do that well and we're able to outperform and keep on basically generating greater rewards for the risk that the capital is having to take by backing us, we will be able to access more and more capital. And it's the same for everybody, right? Like, it's just like, compelling stories can increase multiples, right? They can increase valuations. They can make it easy for you to access capital. But basically, all of this capital just wants to increase. That's like the goal broadly of kind of like of all capital. So with that sort of like subcontext, right? It's like, okay, well, like, why is the goal IPO? Well, no founder is starting with some money can be a motivation, right? But I think like probably the better mission-driven founders, like their goal is not an IPO. Right? An IPO would just be another step on a road, which is a thing that they might have to do at some sort of point, right? But for the capital that you're raising at the earliest stages of venture, right? Whether it's from your friends and family, from angels, from the funds or the accelerators to the Series A, Series B funds, all these guys, right? These guys aren't giving you money that you just have forever, right? They're giving you money with the expectation of a return. And they're only doing it on the basis that you might return substantially more than what they give you at some point in the future. The question is how? And the reason we simplify and we say, well, like IPO is the goal, especially because it's a sort of like the liquidity event, right? And for all great companies, this is just like not even the midpoint of their journey, right? The IPO is like the end of the beginning of a company, you know, and then it's like you continue kind of like beyond that, right? The greatest technology companies that we know, right? Whether it's Microsoft's, Google's, Amazon's really impressive as a case. We won't go into that, but like they went IPO'd very early in their journey. And Bezos did not have like super voting shares or any of these things. And his ability to navigate that public company with a minority interest is like very, very impressive as a side point. In comparison, Zuck has always had super voting shares and has always just been able to be like effectively like this is how it happens, right? Side point. Those companies have all been public for ages and they have grown and had far, far more impact post being public than they were pre-public, right? So IPOs are really just like the beginning of the end of the beginning, you know, of another kind of like a phase. But they're a very important stage because they are a liquidity event where like these early investors are able to get their capital back. Now, again, if you end up backing a Facebook, right, and you're a Peter Thiel that wrote them their sort of like first ticket and you sold all your shares in the IPO, one, you wouldn't be able to because there'd be some lockups of some description and it would be like managed over a vesting period post IPO. But basically you would perform very well if you hadn't sold there, right? So liquidity can be a curse, right? That it gives the ability to sell, it gives the ability to have weak hands and to do. But these guys need to return capital to the people that they got capital from, which are the LPs, the limited partners. And so they need to sell so that they can recycle capital, raise their new funds and deploy again. So again, the goal is not an IPO. The IPO is an event which basically allows capital to recycle back to the kind of like the early backers, generate the returns and raise more funds to then fund future innovation and take it on this journey sort of again, right? But like from the money's perspective, the money that's being invested here, the money's goal is effectively to exit at some point. And the best exit is typically an IPO. Why? IPOs are not all good. You have very small IPOs as well. But the reason IPOs are goal as opposed to like selling your company is because basically if you've sold your company, it means that like typically there's someone bigger in the market that like has bought you. Like if the only thing you can do is IPO, it's because you've created something so big that no one could afford to buy you, right? And you are like the winner of this market, right? And you have an ability to be this like independent kind of like company. So IPO is the goal. M&A can obviously be great outcomes as well. But yeah, hopefully that makes some sense.
Let me ask you some questions that we had dilemmas, right? We were running a company for 10 years and we had some dilemmas and I'm wondering what's your take on these. So one of the things that happened early on is that we launched the company and in 1 or 2 years with, you know, zero funding, zero invested capital, anything, because it was just a software, just a server and a client software. We went from zero to millions of dollars as income. Okay, so then people started to come to us. One interesting thing was that a Japanese venture capital firm get a meeting with me online. I woke up at 3 a.m. in the morning, so whatever. They didn't invest, but yeah, okay. So why didn't they invest? That's a question. I never know. They never called back right after the meeting, even though we had like a huge financial upside that they were really interested about. Okay, you don't know. Fine. Other people, those were not venture people, like people probably who had like lots of money. They were also reaching out to us, and this happened in within a year maybe, when we were so hot that everyone wanted. And we were never selling anything, right? We didn't want to sell. But later on, we were still growing, but not like from zero to... and then people were not really reaching out to us anymore. So what's the dilemma? Should have we sold some early on and then try to get onto like seed and what series A, B, C, or did we do well because we were like extremely profitable? We didn't know where to spend the millions of dollars that we were making. Yeah, what's your take on this situation?
It's tough. Like all these things are like extremely context dependent. And so it's always very, very difficult to kind of like to know, right? Most people should not raise capital, right? Because they're not building a business that it's appropriate for, or they don't really want to go on that journey. You know, like it's like, in example, there's lots of people that still even now will come up and be like, yeah, like, you know, I'm going to work on this for the next few years. I'm just like, as soon as you tell me something, you're working on something for 3 years, I'm switched off instantly. Like, I can't even bother to keep talking to you. Like, it's like a waste of my time. Right? like you're doing nothing important. If you're working on it for 3 years, like, it's clearly not significant or important to yourself, let alone to waste my time talking about it. Right. And to be honest, like that, it's like any length of time is that's not infinite is sort of a bit of a red flag, right? So what I'm saying is that's totally fine, right? Again, like they were like, again, it's like we said, opening the coffee shop on your road, there's a single branch that serves a whole bunch of your local community coffee successfully every day. Fucking worthy endeavor, go do it, you know? But if you want to do venture, most companies don't qualify, and most founders should not do venture, right? So like, whatever it is, right? And then for the ones that should, right? Most are not going to be able to raise capital because it's very, very difficult. The problem with all the information that's presented to people about raising capital is that it basically always comes from successful founders that have raised capital, or from venture capitalists that give money, and both of these people have complete survivor bias. They are the antithesis to the rule, of which that most founders are not able to actually go and successfully raise capital, right? Like, it's not hard for fucking venture cap. They've got a pot of money, they spend it, right? It's like really not hard, right? Like, I promise you'd be great at, spending, $100 million fund. Whether you'd be great at doing it and generating a return is a different matter, right? But it's easy to spend money. So I'm just saying, like, the information is that, like, you often hear it's like, oh, it's easy. Well, like, I raised my round in a week, or like, you hear investors all the time going like, oh my God, like, don't take money from the investor unless you're like really sure, and all this sort of stuff, right? And the reality for most entrepreneurs and most founders is like, they're going to run out of money tomorrow. They'll take it from the dog down the street, like, if they can get it, right? Because you're just fighting to try and continue sort of like the mission. So it's, again, there's lots of stuff here that's sort of like going on. But yes, often the founders, you're in like a valley of despair and death, and then it's a desert, and then like everyone wants to invest in you all at once, and then it does become sort of easy. But like, just be careful. There's like a lot of misinformation about the reality of how things sort of like happen, kind of like here. Some people obviously have an easier time, others find it harder. But like, why do some people raise capital and other people not raise capital?
Okay, so the next thing is that how much we eventually ended up raising capital, not because we needed any money, but because we wanted to, like, this is how we reasoned. Since we were building anonymous money, it's better to distribute the ownership of the company between different actors. Therefore, we should still raise once in a while some amount of money. Yeah, this probably made sense. But then the question is, okay, how much are you really selling? How do you value your company? And then there were so many different ways to value, like, okay, so this is how much revenue you have, then you look at it for a year, and then you 10x that, and that should be your aim of what should be but we couldn't really like figure out, okay, how much should we ask for this thing, so how to figure out how much to ask.
Well, when we covered this in the session, right, it's like the amount of money that you should raise is the amount of capital it requires you to hit the milestones to raise your next round. All right. And to
the amount of capital that requires you to hit the milestones to raise your next round. Okay, we got around 350,000. Yeah, the thing is that we didn't like dilute the shares. We are like selling it like a bag of potatoes, right? We sold 3.5% to Cypherpunk Holdings, and they give us $350,000, something like that. It was eventually 7,500,000 something valuation, or 9 million. I don't even remember. Okay, whatever. What's the point? To require for the next one. Therefore, we didn't do it, right? Because we didn't require this money at all. In fact, we kind of had even more money in the bank as a savings at that point.
But but I think it depends. Again, it's like, but you probably weren't deploying a proper venture plan. It's like the again, like for example, let's take Uber as an example, right?
Okay.
Uber, I think raised probably like $10 billion for its life, and is now probably valued at $70 billion or something on the New York Stock Exchange or the Nasdaq, whichever one it is. Uber basically had every single government everywhere in the world try and shut it down. Right? Mm-hmm. Every single government everywhere. Mm-hmm. Right? They raised billions of dollars of capital to hire lobbyists and lawyers and to fight that battle globally in every single market. Yeah. And because of that, they captured and built a near $100 billion company, right? You, if you're doing the venture route, should have raised billions of dollars to go and litigate and lobby every single government in the world to basically know that, privacy is a fucking human right, and that this is the tool that does it. Just it's the exact same model that Uber kind of like played, right? And that would have been the venture thing. It's like, okay, well, you might be profitable, but you can't afford to hire a team of lawyers in 100 markets. So actually to do that, you needed hundreds of millions of dollars. And so that would have been the venture play with what you're doing. And then you'd be like, well, okay, well, how do we, what do we need to unlock the next milestone? It's like, okay, we're raising $1 billion now to fight these 15 markets. We're going to need to raise, let's say, $5 billion to fight the next 50 markets after this, right? And why? Because again, you've got to have that trajectory, because no one's going to give you the $1 billion to fight for these 15 markets unless you're telling a story about unlocking the entire world and returning capital for them, making that sort of like return. So what this does is like basically, this is what I say, it's about a scale of ambition, right?
I guess this kind of hurts because that just shows how incompetent we were in this thing.
No. But this is why. But none of this stuff is
obvious.
It's simple, or why do I know that? Because I've been doing it. I just like, again, you have a job in venture, you're part of this, you do it, you're just like, it's only obvious if you've done it, really.
Why do you know?
Yes, this is all I've done and been around for.
What have you done?
Oh, yeah. I mean, like, it's I think my interest in this stuff has been from 17 or 18, right? Back then I would read, every single TechCrunch article. And back then TechCrunch was like the startup press, basically, like 20 years ago. And I would probably literally read every single article that would like come out, and I would just absorb like absolutely everything, right? And this is just like a university guild kind of like kid. And I was playing with stuff. I tried to build my first company at university, but I should have probably, I think if I burnt the boats, for the analogy, then like that company could have been successful.
What's burning boats?
I need to, it's a comfortable time, and I'm really bad at remembering names, but like in the sort of like Chinese, sort of like dynastic wars, kind of like the Bromance era, etc. There's a famous battle with
Battle of Metaphor.
Battle of Julu, whatever it is, where a guy sails up a river, lands. These are facing a much bigger army, and so he decides to not just burn all the boats, but he destroys all of their supplies. So they have like 3 days to completely defeat the enemy. And so the point here is that like if you have no other options, it makes you concentrate and do even better.
What could have you done?
Well, the challenge was that I had an option of like a very like of my dream like graduate job kind of like lined up, and I had like a really good alternate option, and so it's like instead of like fighting the war, it's like, well, I could just like go and take this like, this like empty land over here that was, and I was like, okay, well, let me do that then, pathetic basically. But no, yeah, so, but playing around with stuff there, and then, I definitely did a couple of years in corporate, but, I was still even, interested in and working on stuff on the side and stuff. And then, yeah, I mean, I guess I was very lucky. I was able to get kind of like a job in venture capital in like 2013 in, kind of in London. That's like very, very, very early on in the venture scene.
2013 was early on in the venture scene
in Europe, and in London, particularly for like the early stage venture scene. There would be there were like very few funds in the UK that were like started in the 2000s and not 2010. So that was definitely early. So just like lived and breathed it, and then have just like been, investing in companies one way or the other.
What's a day in your life was at that point?
Oh God, I mean, like I was just like absorbing and just start trying to learn from anyone and everything. I was very lucky. Like I worked at this fund called Playfair Capital, and like they didn't tell me anything to do. And it's hilarious because like the day, like you can be, you can be nobody, and then like you can be one day into your job in venture capital and people will put you on stage anywhere. You can just go do a conference circuit, because, and you've done one day in venture. Mm-hmm. And honestly, the partner, the more senior partners and all the rest of it that have been around, like, they can't be bothered to go whatever it is. They're very quite happy to outsource this stuff to the kids, at the funds that have absolutely no fucking idea what they're doing or how to build companies. But yes, so mine was very varied, and I was coding a lot of the time as well. Like I had been coding before my venture. I was I was working as a software developer, as a web developer, and I was working with different technical teams, and I was just trying to just like learning the craft. Like, if I'm going to be building technology companies, I should like understand how it's happening. And so I learned to code, and I was like coding within a bunch of different startups, and I would even work for free just so I could like come into a team for a month and like learn under a different CTO in a different kind of like group. And I like continued a lot of that when I was sort of in venture. And I was just like this junior little kid on the team with these like kind of like three partners. And I just got to sit like in this office of investors and just sort of like learn by osmosis from like all of these people around me, like doing deals, And we're very fortunate as well that we had, again, it's all very early, 2013, like there weren't really accelerators, for example, anywhere outside of the US. Like I think like one of the first was like a thing called Springboard in the UK that probably started in like 2011, 2012 by a guy called John Bradford. He probably doesn't remember me, like long, shorter hair and stuff, but he used to sit in this co-investing space that my fund ran as well. Springboard was acquired by Techstars. And the first Techstars outside of the US happened in our office as well. And I was there when I saw them, open the call for applications for the first Techstars. I was there, they were like assessing and funneling down, I think it was like 1,500 applications to 10 teams that they would work with. And then all of those teams came in and were in the office. And so I've just been like, like around a lot of this stuff from like kind of like the earliest sort of like days of it happening in sort of like in Europe. And so I've always been on the investing side of the table. And in one capacity or the other, but I don't consider myself an investor at all. I build things. I kind of like create things, and then I've had varying levels of success of building companies sort of like myself. And some have been kind of definitely like disastrous and have like blown up and lost plenty of money and lost sort of like had to fire lots of people and all these sorts of things. But again, it's all of this stuff has just been like, training an internal model of how this stuff happens, right? And I only know these things because I have been through them before, not because I was born with them, right? And so I think like all of these things are non-obvious. you know, until you've gone through them kind of at least once or twice. And it's why I think, like, you know, yeah, second time founders and stuff have like such an advantage, because you just, yeah, understand what you're getting into, you know?
Okay, so there was another thing that you said in the presentation, that the more you can push from, how did you phrase? Doesn't matter. The more you can stay away from getting any money until the seed, the better it is. So you shouldn't give away money to co-founders, to angels, to accelerators, anything like that. But if you can survive getting to the seed investment, that's how you end up being like in the best position.
So I think probably what I said in the session was that for the investors that are in this journey, and particularly the investors that are sat at like Series A, Series B, which is kind of like considered like more like growth capital, it's a very, very different kind of like risk equation at Series A. You should have, for context, at Series A, you should have proven product market fit, which is basically that you have built something that people really want and you have evidence of that, right? Typically that means that they're paying for stuff, and not just that they're paying, but they're paying on a recurring basis, and that they stay with you over a long period of time. Also that you know how much it costs to acquire those customers, right? And that then the economics of this add up, right? So that actually it costs you less to acquire a customer than you make from that customer. Actually, it costs a lot less, so that you can return a multiple on your acquisition spend, so that you can acquire even more in the future, and you can sort of accelerate that curve. So for you to be, you know, pre-Series A, you haven't proven these things. You maybe haven't built a product. You don't have any customers. You don't charge them anything. You don't know how to acquire them. You don't know if the economics stack up and that you can continue to do this on a recurring basis. By Series A, Series B, you've sort of, you know, you've de-risked this stuff, and it's more about growing, and can you really fucking put on the fire and get on with this stuff, right? Which are a whole different set of challenges. And one of the things that's really tough as a founder is that, like, the things you need to be good at to go from 0 to 1 are very, very different to the things that you need to be good at to go from Series A onwards, right? And most people are not capable of either of those things, let alone both of those things. And growth is extremely different to IPO as well. And this is the challenge, right? There's probably at least 3 very distinct phases of leadership of a company that most people can't do one of them, let alone all 3, you know? But anyway, so the point is, into your question, so the reason I explained what Series A, Series B was because these guys are looking at it, right? And they're going, okay, we want to invest now, and we want to invest into a founder or a set of founders and a management team that they believe will work for the next 10, 15, 20 years on this through the rest of this journey, right? And they want to ensure that they are incentivized to do that. And what they care about is it being, and traditionally, again, ventures bias typically has been towards founder-led companies, right? And you care about, you know, it's just like, professional CEOs are generally seen as a bad thing. The companies perform worse. It's expensive to hire one, and you have to do all this sort of stuff, right? And so they're going, okay, will these founders be happy to work on this for another decade? And so they care a lot about it still being your company, and about it, you having enough ownership interest in that company that you're going to be incentivized through this journey. Now, this can be a little bit perverse. I have literally been in a situation where, like, I could not care less about the financial outcome of what we're doing, right? And I've got investors out there going, oh God, yeah, maybe, you know, maybe you don't have enough of the company. I'm like, yeah, okay, great. Well, like, I mean, you want to give me more? Fine, you know, just could not care less. But so it can be a little bit perverse at times. But this is an answer to your question that, like, these Series A investors here, right? If you do not have 50% of the company still at this point, that's like a real red flag. And the thing is, okay, well, if we're saying that your Series A, you still need to have at least 50% of the company, that means that through your seed, through your pre-seed, through any sort of accelerator, through any angels, and through any friends of family, you still need to have 50%, right? Like, and that's not necessarily simple. right? These things stack and they compound differently, but it's like, okay, 20% for a seed would be absolutely normal. It'd be very normal to give 20% away for a pre-seed, right? Maybe you can get away with it being less, like 10, 15%, be very normal. An accelerator is going to take 5, 6, 7% of your company as well. What are we at here? 20, 15, so 35, so like 42. And then if you've raised a round from angels or friends or family at like 10%, you're already above the 52% threshold. Right, you're already above the 50% threshold. That's 52%, and so they're sat there going like, "Oh Christ!" Because you're not just going to raise this in the Series A. You're going to dilute another 20%. In the Series B, you're going to dilute 15%. In the Series C, 15%. In the Series D, 10%. And suddenly, this company that you thought was your company, you're a minority owner, and you're working for other people. And again, I think a lot of people could not care less. I think, like, for example, like I think a famous example I know off the top of my head is like Aaron Levy, who I got to meet at one point, from Box, CEO of Box. I think when he went public, I think he owned 6% of Box. You know, that still makes him extremely rich. And good job, you know, and Box continues to grow and they're doing well. I'm trying to think, like, yeah, like Box bought Dropbox, and Box is still an independent listed company. I think. Is it? Okay. I think it is. But yeah, so I hope that's a bit of an answer to your question.
Okay. Another dilemma that I had, and I'm still not sure what to think about it to this day, is that I was alone. I was building anonymous money. And I was a developer. And I know nothing about law and regulation and anything. So my idea was to team up with 2 lawyers. Turns out one of them wasn't a lawyer. They were just running a law firm, and one of them was a lawyer. The other is an economist. Doesn't matter. The point is that I teamed up with them, but I wanted them to be the CEOs, co-CEOs of the entire adventure, right? And they didn't do anything at that point. I'm 2 years into this, right, working on it, and I gave up exactly half of the entire company, right? Like, but in some sense, it was a super stupid move, right? Like, I gave up half of the company for. And they demonstrated nothing other than they being that part of the equation. But on the other hand, I kind of needed to de-risk my position. This is not quite your expertise, I'm afraid, either. But do you have some wisdom to throw at it?
50% of a company is a lot.
Yeah, it's a lot.
You know, if you think about it, you want to sell it for a lot of money, and that money can buy you everything else. And this is why I actually encourage founders often to, you know, it's highly unlikely that the best person to give you advice on a particular topic is the particular partner of the fund that has led your deal. You know, it's much more likely that their money can buy access to a much better kind of like advisor. Mm-hmm. It's not always true. There are honestly some incredible partners at funds that just, if they come on the journey with you and they understand your context and they can sit with you and have been on that journey and understand the company and have seen these particular types of journeys again and again and again, that actually like that expertise actually like outweighs an actual expert on any given topic, because just like the localized context of that particular company and this particular type of journeys is so abstract for other stuff, right? But like for longevity though, right? It's like you might have a really great doctor on your board, right? But it's, for any given 100 topics on longevity, there's going to be probably like, they're not going to be the number one expert in the world for these 100 things. There's going to be a better doctor somewhere in the world, right? Mm-hmm. And if you care about a particular form of cancer, you should probably go and talk to the expert, not this person. What am I saying with all of this is that money is this beautiful thing that it gives you optionality, right? And that, like, as opposed to you getting one person, if you get $1 million, you can then buy the expertise of 100 people, right? Maybe that's a little bit sort of like abstract, right? But it's like, I don't know enough about the context of like what you'd achieved at the point that you gave half of your company away. Mm-hmm. But I think that unless you are right at the beginning of a co-founder journey, 50-50 is normally not the right split of a kind of like a company. Even right at the beginning, it's often makes more sense to have a sort of like a different split.
Yeah.
And there is a reality that the CEO is going to be more important over the life of the company, regardless. And that's often actually like a bit of a source of co-founder conflict, because whoever's not the CEO starts to realize that, as you go up this journey, no one wants to talk to anyone.
I didn't think of that. I still was effective the CEO, even though not on paper,
Yeah, so that would have been a red flag for an investor, as like an example. There not being a clear CEO that like all the founders like rally around is a bit of a red flag. You want there to be a clear leadership structure, and like you want to try and de-risk or like basically rule out the risk that there is going to be a co-founder conflict, because there's a competition for power. Co-CEOs is very unusual. It does happen in places, but it's unusual, and anything unusual is again, like venture, they don't like adventure, right? And actually, this risk capital doesn't like taking risk. It's broadly about like completely concentrating the risk onto this one particular innovation that you're trying to do, right? Which is why I say to founders all the time as well, it's like, just copy paste everything other than the one thing that you are doing different in the world, because like hell, you might be smarter than everybody about everything, but it's like unlikely. And even if you are, just channel that into being even smarter about the one thing, and just copy paste everything else that's kind of like going on, where you can, but also just like feel comfortable to do whatever and does feel right for you. So I expect that you should not have done the deal of giving the 50% sort of like kind of like away, but maybe it made a lot of sense. I hear you that you wanted the defense and sort of all the rest of it, but probably raising capital the right way to then buy that defense through a set of lawyers or through whatever it is would have been a smarter use of 50% of the kind of like company. But like, it all depends. And again, it's really easy to see. You have to be careful that we're not in this like survivor bias conversation again, where it's like really easy to say this shit when you're in the trenches and you're doing stuff, right? Like, Christ, you don't have like, you like when you're a founder, you don't have like, like all the world's best options and you just get to choose. That's just not how it is, right? It's like you've got this really clear answer of like death, right? Like here, and then there might be a couple of other options, and like maybe, yeah. So you just got to be realistic about it,
Okay, another one. So finally, we raised money, right? And we were by far the best performing thing for that fund. It was a publicly listed fund in Canada. They were like investing in specifically privacy ventures, right?
Cool.
Okay, so we were by far the best performing. We were probably the only one that gave back all the money and more to them. They eventually has to close it because all the privacy projects were just killed by regulators,
It was a publicly traded fund. I love that. Publicly traded fund investing in privacy companies. Good.
Yeah. Well, I don't know if it's fund or what's the legal stuff. It's called Cyber or Cypherpunk Holdings.
Cool.
Right. Okay. So, my question to you is that what we did is that they sent us the money, and then every half a year we had like a half an hour meeting with one of the representative of that fund, and it was so offhand, like there is nothing was happening, right? Like sometimes they didn't even want to come to the meeting and stuff. Like, is that normal? I was really wondering, is that normal?
They wrote a $350K ticket, yeah. Is that these investors? They invested $350,000. Was it that? Was those investors?
Something like that. Perhaps 500,000.
And they did this in a lot of
like
companies.
3.5%.
And they did a lot of companies. They invested in a lot of companies.
Yeah, I probably like maximum 10.
Okay, which is not too many, but like, yeah. And this was their main business, was just investing.
Yeah.
Or they did other stuff.
Yes. This.
Yeah, I mean, like, look, I think that's an example actually of like a good investor in a way, right? Like I think like that's the investor that you would hope for, right?
It will
where they do not
from...
intervene. Yeah, right.
Okay.
Because like the reality is that most partners at funds,
Mm-hmm.
you know, just, you know, yeah, do not know how to run your company better than you. And if they think they do, or they try and run your company, then
We would
that's
have
problematic.
wanted the input, you know, we were always asking.
Yeah. No, yeah, but then on the other hand, right? Like maybe like the greatest investors then are available to help when you want or you need it, right? But there's a challenge that investors only have so much time, and it gets concentrated on their winners as well, typically, right? Well, one also they just don't want to really work anyway, right? Like it's not exactly like, you know. But what I'm saying was so like the incentives are often that they're just like very deliberately structuring a portfolio where they are deploying across enough things that they are not, they're just, there is no intention to work closely with any of these, right? Like they're taking a portfolio approach. They expect a bunch of them to fail. They're not going to intervene. It's totally fine. The best founders will make it work themselves, and they'll just answer the phone when you call them, right? And they're not going to pester you, right? And then it's just tricky, right? But because imagine that a partner invests in 20 deals, right? And it's like, well, they can't help all of those companies anyway, you know? And so they'll end up spending more time on the companies which end up being the rocket ships. And that's where they'll focus and add kind of like more. So, yeah, being a favorite of your venture capital firm is helpful, because they can be useful in lots of ways. They can.
All right. I have one more big question to you about this topic, which is, all right, I know how to get to a product that makes money, right? Now then, the problematic part for me is how to raise your first, I'm not even sure if you should say seed, perhaps it's already Series A at that point. Like, what do you even do? Do you go and cold email all the investors, or just appear magically in their places, like, or is that like a lot of, you know, work because you have to travel to city, and so how do you even get in contact with these people first, and then let's go further from contact?
I think there's not like a short or simple answer to this, right? We can cover it briefly again in that sort of like session, but there is no silver bullet, right? The shortest thing is that it's like, if you want to raise capital in 10 years' time, you might as well start trying to raise it right now. And you do that by being an active participant in that ecosystem, and by adding value to
what ecosystem?
in this game, in the ecosystem of players that are playing this game, from the angels to the accelerators to the funds, the pre-seed funds, the seed funds. If you are actively participating in this arena, how can you participate in this arena? You can go and get a job at a venture capital fund.
Oh, I can come to you to ask for contacts, right?
But I'm serious. So I'm saying that this is obviously not the situation that you're normally in, right? The situation normally is that you're already running your company and you need the money now. But ideally, the point is that, like, there is no shortcut to this. And ideally, you started 10 years ago, and you've been building a set of relationships and reputation from being a part of this game over a long period of time, such that, and whenever you hear a story of a founder like raising a round in a week, it's because like they already knew everybody. And so, like, if I want to, I can get meetings with 50 partners next week, right? And that's not because I have like a magic wand. It's because I've spent 20 years working in in this stuff, right? And so I don't think there is a shortcut, right? And let's imagine you start today and you have 0 days. Like, how do you get 50 meetings with partners, right?
Okay.
Like, there's no right or wrong approach here. But
meeting meaning like just in online, or
yeah, like a 30-minute, whether it's face to face, whether it's online, whatever it is. How do you get like 50 kind of like partner meetings?
Does it like even make sense in terms of like time management to fly to that country to have a meeting with
not for first meetings? No, not for first meetings, unless you're like very like, look, it depends also on the situation that you're in, right? Like at Series A, like that if you have a certain set of metrics, that you are going to be able to raise capital, unless there's like a red flag, right? Like someone will fund you, right? Like if you have, growth capital and onwards is very different to this sort of stuff here, right? If you've got the metrics. The challenge is most seed companies do not get the metrics required for Series A, right? So I mean, the strategy also like very much depends on what kind of like where you kind of like are, right? Because like at this point here where like if you have the metrics, you probably don't need to talk to 50 partners. If you just talk to the 10 most relevant partners that are, or even the 5 most relevant partners that are doing deals that are related or like, they've been tweeting about the stuff that you do, right? And if you can just get in contact with those 5, like the reason you would want to talk to 50 is to have more negotiating leverage and to push it all up. But you can save yourself a lot of time by just being like, these are the people I want to work with. This is going on, right? But then like they might have a lot more leverage over you, right? Even if you're concentrating it down to like 5 partners at this point here, like how do you get in contact with those 5 partners, right? Well, like, okay, there are, if you don't even know who the funds are or the partners are, again, just trying to assume you just like know nothing about and know nobody and know nothing, right? Then you need to like go online and like there are loads of lists of investors online. So you can find lists of investors, and those lists of investors are often categorized or tagged by like the type of things that people kind of like invest in, right? You can also like find companies that you think are similar. So like if you're doing privacy stuff, you might be like, okay, well, who has backed Zama? Who has backed Aztec? Who has backed what it right? And then you go look at those investors, that they obviously have a thesis on this space and they believe in this sort of stuff. And maybe they've even made some money investing in that space, right? These are like good potential targets, right? So you've got to get a target list. And then you've got to work out like, well, how do I actually have a meeting with these people, right? And so you can cold email them. And actually, given it doesn't take very much time, I think it's actually like a worthy strategy. But you should expect your hit rate on cold emails to be low. However, if you are particularly at the Series A stage, if you have the metrics to raise and you cold email like a partner of one of these funds, even 5, I bet you're going to get an answer from one of them. If you craft the right email, that email has to be, you have to like show that you have the right traction and the right scale in the sector that's right for that partner in the first words of that email, and it has to be so short. So even cold emails can work, particularly further down the line.
First contact established. Now what do we do? What do we want? What do we want? We want money, but we have to give something in return. It's going to be shares, but there's always some kinds of like, you see, it's never just selling shares. Like, what? If you fail, then it's not going to be I failed. Your money is gone, right? There is always all kinds of clauses that
they should be like
protects the investor.
They should be like that. If people are doing venture investing, the expected outcome is 0.
But what should you avoid giving up?
Loads of stuff. Control.
Voting. Yeah.
You want to. You got to be cautious. Yeah, you want to make sure that you have control of the board.
Yeah.
When you do a deal like at Series A, the legal documents are going to be hundreds of pages long. And most of that stuff isn't going to matter very much. It's like a whole bunch of share certificates. It's whatever it is. But there are going to be some things there that really do matter. Control is going to be important. Mm-hmm. Any conditions that there is around like leaver clauses, leaver clauses. Like you have like good, neutral, bad leaver clauses, which is like if you leave the company, like what sort of like conditions that you're left under. You want to make sure that you're kind of like okay. I mean, you probably want to make sure that you can't be fired. Like there's all sorts of stuff like this, right? And then there's going to be like some reserved matters that like, that like require sort of like typically like investor director kind of like consent. Even if you have control of the board, it might require their consent to do them. You probably want to limit that to as near to 0 as you can. There's lots of stuff, but like control and ensuring that you can continue to build your company in the way that you want to is probably the number one thing.
Things like how can you raise in the future? Okay, that's what we want. We want the money to enough to execute the plan to raise the next round, right? We got the contact. how do we convince them that we are worthy of writing the paycheck? How do we do the first money? We are still talking about the first one.
Again, there are no simple answers to this. And again, it depends on the stage of the company that you're at, right? But like here, like as soon as you're in growth stage, it's very much more about like the metrics. It's just like, do you have the metrics? Do you present the metrics? Then like fundamentally you should get invested unless you just look like a big red flag.
About the metrics.
Yeah, all that matters beyond here is the metrics, right? Again, it's just all about the numbers. It's just like it's just like stories around numbers, right? It's all about the underlying numbers, right? Yeah. If you have the metrics, you can raise capital. If you do not, you will never raise capital. It's completely irrelevant. It doesn't matter how good your story is. It's Series A and onwards, like if you do not have the metrics, you're never raising capital. It's just completely, it's if you have the metrics, it's then a question of like really like, you still might not if you're like a walking red flag. Like maybe you've got really bad shareholders and the terms there, and maybe you can't do it for whatever reason. Maybe you're like these people are like, we just can't back this person despite the good metrics. Like you can't kind of like do it. But like broadly, like if you've got the metrics at growth stage, you're going to be able to raise. And then it's just a question of like how can you compel and how can you get the right partner and bring them together and get the capital that you want at a valuation that you're happy with, in a period of time that's not forever, to get on with this stuff. Down here it's very, very different. Like down here it's like, this is much more story driven, because you have much less data to make investing decisions on right down here. So it's very different games, pre and post Series A,
Right now, I'm working on the Longevity World Cup. I did not start this adventure for creating a company and money, but rather as a hobby that motivates me and keeps on track on my fitness goals. And it does seem like it's only just a matter of a couple of years and I'm going to be like in the best shape of my life, right? But soon I will bump into a decision to be made that, do I want this thing to be my career forward, or do I just want this to be like a hobby? I think it can pay for itself. I think it should be possible to make it big, $1 billion, right? Like the UFC came from nothing. Like you should be able to scale it up, but there is no straightforward way. Like with Wasabi Wallet, the way was people download the wallet, they are anonymizing their money, we get money from that. The more people download the wallet and gets privacy, the more money we get, right? Like it's some people call it an infinite money glitch because you just had to run a server. But in the Longevity World Cup, there is no such a infinite money glitch, right? Or I haven't found any. So I will end up making this decision that, should I continue with this? Is this because this is a new problem as well. So that fits your your game. But ultimately, do you think where does it really fail? I have an intuition that it fails. Yeah, I shouldn't play this game with the Longevity World Cup, and I'm not sure why.
Well, the minute it fails with you, right? Because you will need to project absolute confidence on all of these things. That doesn't mean you have to know everything. You can have known unknowns, but you have to still be projecting confidence that you like think that there are all ways around those. You can even in the extreme be like, look, there are these things I'm not sure about, and actually there's a really high chance that we're just not able to solve them, right? But I'm going to commit my life to trying to solve those things, and we need capital to do it. So I'm saying you can be quite honest in all those regards, but you definitely need to be 100% sure that this is like, again, your life mission, that you're going to be working on this, that there is an opportunity here. There might be some unknowns, as there is. This is what we're doing, right? We're like trying to build these things, and like maybe there's like technical risk that it's like never been done before, and we don't even know if we can build it. You know, maybe there's market risk. It's like, well, we can build it, but like maybe nobody fucking wants it. That's more normally the case, right? That's the bigger problem, right? That there is normally.
So look, this is not a problem because that's what the decision is about, right? Do I go all in or keep it as a side hobby?
Sure.
Right? And if I make the decision that I go like completely all in, then we have the confidence part and burning the bridges, right?
Yeah.
Happens.
Yeah.
So, but the question is, should I burn the bridges, right?
Yeah. And I don't like. I'm not an expert of this stuff, you know. So I think like you've got to get because you should basically. That's the thing. You got to get to a point that you can explain to someone else why they should like burn their bridges and join you, right? So you've got to get to that point. You've got to build that case yourself. And like with an investor, right? Some might have a thesis, but particularly the early stage investors here, right? They're more likely to probably be like a generalist investor. Even if they're like sector specific, they're still probably going to be generalist, right? Like they might be like a longevity, bio, health type investor, right? It's like very, 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 very broad, right? And so they're not going to be an expert at anything. Typically, they're going to invest generally, and so what they need you to compel them in a very short period of time to see that there is a mission worthy of backing that is extremely lucrative if it ends up coming to be, right? So again, I know you're asking, you need to know you're trying to work this out for yourself, like yourself, right? But I'm saying like, yeah, like there's a piece of work that needs to happen, right? To work out like, is there a fucking opportunity? Does it make sense? You know? And I don't know because I don't know the industry or the sector kind of like very well, but you've got to just like do that work and work out, you know, is there something here that can be built that, it has the characteristics of a venture backable company.
Could it be what I'm really missing here is the technology, right? In Wasabi Wallet, I had to solve like really hard problems. I had to write fucking cryptographic papers, you know, that no one ever figured out before. And here in the Longevity World Cup, it's not a tool that people are getting finding it useful. It's more like it's a game. I'm just building a game. It's not technology. There is no technology that makes people's life easier. What I'm building is a game that makes people's life harder, because that's the thing about games. It's unnecessary obstacles in people's way, right? So could that be the problem here?
But think like even in the beginning, I can't remember if there's this conversation, but you were talking about how what you're actually creating is like an open source data bank of this data. That's something, you know, that's something maybe not deeper necessarily, but that's something like adjacent to this, right? It's like, is that, you know, again, it's like if you manage to build an incentive mechanism that gets 100 million people to compete in local, regional, national, international competitions, stratified by sex, by age, whatever it is, right? And you're truly able to basically help create the infrastructure for like a new sport. And you're able to like aggregate the data that's being created as part of that. That's probably the world's most valuable data set. I mean, it's like a fork, right? Maybe not the world's most valuable.
Selling it,
but
yeah, you're not capturing the value of the data set.
Why not? Why?
Yeah. Okay.
Why not? Like, why not? Why not?
Even if you do, is like capturing value of data is just not a game that's not a very profitable game. And it's kind of a disgusting game, but it's also not a profitable.
No, but again, so you need to do this work yourself. But I'm like, okay, well, what would be the moral way of playing that game, right? Like, so I'd be like, okay, so the data is actually, I mean, like, you know, it's not private at the minute, but actually, okay, it's as you increasingly give more private, maybe actually the data could be like in a way where it's almost like I'm not an expert, like, but it's FHE or whatever it is, right? So that they can keep on creating their personal data sets, but then actually people could, you can run the competition without actually revealing like substantial parts of the underlying data. Maybe the transparency is very important for people to trust in the competition. But okay, even if it's not, it's, you could say that, okay, the aggregated data set. Okay, but what would be a more moral version of selling that data to research to, cure cancer? That seems like a pretty good thing anyway. But okay, what you could just go, well, we were able to monetize that data set, but we share that money back with the people, or actually it all just goes to filling incentive and prize pools to drive more people to provide more data and to get rewards back to the people that are driving kind of stuff forward. I don't know. And it's like, okay, well, is that really a valuable data set? It's like, okay, well, I would kind of like assume that probably it is, for several reasons. Look at like LLMs at the minute, right? The limiting factor is the quality and the quantity of the data, and the compute, and that allows you to sort of like train the kind of like underlying models, and the energy. These are sort of like to then run those compute and the chips, blah, blah, but these are sort of like the core like limiting factors of like LLMs, like good quality data that can train specific models on all sorts of stuff is probably like very, very helpful. I expect there's all sorts of useful stuff that could come out of the data, and if you can both build a profitable kind of like competition of some description, and you can create this kind of like data set, then like maybe, and a strategy might be that, again, like you don't worry about monetizing the competition because you want as many people playing the competition as possible, because that's actually allows you to build a large data set. But yeah, I don't know the full value. I don't know the value of like medical data and all the rest of it, but I'm assuming it's pretty good versus most data sets in terms of value. But no, I know that's like just, that's like a complete, like one complete, I think about it for like 2 minutes and then I end up in a thing like looking at like that, right? And maybe there's something there, but there's probably like 50 other potential paths around it.
You know what? Let's switch gears from building companies and building competitions to building societies. So, why don't we have enough cities already? Network societies? Why do you need to build another one?
Yeah, I don't think we don't have enough cities. Yeah, a substantial portion of the world could have their life dramatically improved by just being given a better home. Even in existing cities, we're pretty bad at building infrastructure as fast as there is demand for those sort of like cities. So yeah, we absolutely need more cities. We need better cities. Populations are still going to increase. A lot of the places that populations are increasing, the infrastructure is not there. So just a priori, even before anything else, that we absolutely need more cities. We need more infrastructure. We need more homes. We just like need better conditions for people to live in. And we want more of that as well. So it can drive down the cost of existing infrastructure so that we can, again, just like, for the poorest people in the world, like the number one thing you can do to improve the quality of their life is reducing the cost of what are huge amounts of their income, right? And so the accommodation, food, energy, things like this, if you can reduce the cost of those, that can dramatically improve their sort of like life. So
you're trying to build a city for the poorest people in the world?
No.
For better conditions?
No, but if you, yes, tangentially, but I'm not trying to build it I'm not trying to build a city for the poorest people in the world. But any city that you build has the downstream impact of like increasing supply of a good that will then, rebalance the market, right? Mm-hmm. So if we built like 1 billion, of the world's best homes, that would like dramatically and just disperse them, just drop them all over the world randomly, right? 1 billion of the world's best homes, and just like put them in the market, and they would just go to whoever wants to pay whatever they want to pay for them. That would like dramatically change the economics of housing across the world. But no, that's not like so more cities, more housing, more infrastructure. This is all a positive good, and actually a lot of that can really dramatically change the lives of those nearest or in kind of like poverty. We are trying to build, we're trying to solve different parts of these problems. we care about building particular cities which are, probably not like taking people out of shanty towns or slums into sort of like, first, the kind of like the next step. I think we're interested in creating cities that are probably closer to utopia, for people that maybe have many options and many places that they can sort of like be. I think we're
Well,
closer
what
to that
kind
stuff.
of people? Is it like the dark talent kind the Balaji is talking about all the time, or is it like the the people who are working at big companies like remote workers, or what kind of people are you trying to attract here?
I think that like depending on where you're building a city, you build a different product depending on what you're building, right? Like you build something different in the Caribbean to what you're building in the Swiss Alps. And depending on the product that you built, not all products are suitable for all people. And so there's like a few different puzzle pieces that have to be kind of like put to kind of like together, kind of like here. But like broadly, what we care about is we care about building better systems of governance that unlock a whole bunch of downstream benefits from those sort of stuff, right?
Better systems of government.
Yeah, or we want to create better worlds that are more conducive for, particularly for innovation and for creating sort of like wealth, health, just generally sort of like uplifting the people both in a city or in an environment and outside of that, right? So that's like kind of like fairly abstract, but it's like maybe like the longevity, for you as a sort of like canonical kind of example of this, right? Where it's like if you want to bring a new drug, if you're like a researcher in the lab in the US and you have a breakthrough and you want to like inject it into your kind of like body tomorrow because you think it's going to save you from this thing that you're dying of, right? Or like your partner, right? That you've been trying working your life to try and save your partner. You can't actually just do that. You need to go through $1 billion process. It takes 10 years to be able to legally give them the drug that you would like happily give them to save them from the thing that they're dying of, right? Mm-hmm. And some of this $1 billion and this 10-year process is money well spent, and is time well spent, right? Like you want to be sure that you are not going to kill a bunch of people, but et cetera, et cetera, et cetera. But actually, like the reality of this time and the reality of this money is that actually it's just like it's completely ineffective. And what you can actually do is you can build an alternate system that preserves the same effectiveness of the process in terms of safety and standards, but actually reduces the time and the cost by an order of magnitude, right? So, for example, this is what was Vitalia and now is Infinita that's working at sort of like in the Prospera kind of like zone is kind of like focused on sort of like doing, where it's like, the legislation and the regulation that we have from the FDA, we have to understand like fundamentally kills people every single day, right? And actually, if you can design alternates that bring drugs to market faster at lower costs, you are saving people's lives dramatically, potentially, right? And so this is like there, but it's like here, we were talking a second ago about housing in cities, right? Anywhere in the world, housing is expensive. It is expensive because governments make it expensive. They stop you building new housing. They tell you what type of housing that you can actually kind of like build. They do not allow a market to fairly sort of like react and build supply for things that people are demanding. Like there are constrained spaces where it is just like very, very difficult, but it's like, again, you can look at, it's like San Francisco, right? Like you can look at pictures of San Francisco downtown now and like, 70 years ago, and it is identical. There has been no development. San Francisco is expensive because the San Francisco government has not allowed you to build, right? Like there are the 99% or whatever San Francisco can't develop above like 3 floors, right? It's like, this is sort of like, this is silly. So like there's regulation and government intervention, massively drives up the cost of all types of products and services. And this causes death, it causes poverty, it causes all sorts of problems.
Why do you think you have a solution to this? I mean, if this is the crowd is going to come to you with pitchforks to ban Uber, right? In Hungary, the taxi crowd came to the government with pitchforks to ban Uber. There is no Uber in Hungary because of this, right? Like, why do you think you have a solution for this?
For what? What's the for
Well, the regulation is actually pushed by the people.
Oh, okay. So you're saying that there are rules. Yeah, okay. When this is exactly the chat. So, example, London has a similar situation where, for very large parts of London, you are also not allowed to build above the current because it has what's called protected views that actually run across the city. So it's like if you go on Hampstead Heath and you look across the city, you're looking across like a thing which is protected where people can't like interfere with that bit, right?
Mm-hmm.
Okay. So that could be a completely viable, okay strategy, right? And it's like, and citizens can go and vote for that, right? That we're not going to allow anyone to build above 3 stories in our place. Every single person that votes for that needs to understand that they are voting for poverty, right? That the cost of their nice view is
They need to understand it.
Well, I'm just saying, they should understand that their vote to protect their view is a vote to increase the cost of living for someone else, right?
Yes.
And that's a totally viable strategy. Like, as in that you can build a beautiful 1-story residential area and just go and do that, right? But there are other strategies. You just need to understand the trade-offs of these choices that people are kind of like making, you know? It just needs to be very, very clear that like building regulations, housing regulations, stopping the construction of new kind of like houses, maybe that preserves nature. But again, for the poorest people in society, that is driving up the costs of what is a much, much larger percentage of their income that they have to spend, you know, than the rich that might be, you know, worrying about their nice green trees outside their house.
I understand and agree this, but what I'm trying to claim is that the incentives are fundamentally misaligned because you're not going to be able to convince, like what Milei did in Argentina is not something that anyone else is able to do, that convince an entire population to go in the direction of freedom, right? Like, okay, so I don't think you can do that.
You 100% can. I mean, you just gave an example, you know, of Milei doing it, right? Or Bukele doing it in El Salvador. There are like, and there are going to be more and more of these examples.
Bukele is different, but okay.
Sure. But like, again, like good governance can dramatically change the outcomes of sort of like nations, right? If you look at Milei, right, like you had like the World Economic Forum and the World Bank going like, oh my God, if Milei gets elected, like the economy is going to fucking crash. It's going to blow up. It's going to be insane. And it's doing an incredible job, right? Again, same with Bukele, like just like every formal institution shitting on him. But like for the average person in El Salvador, he has dramatically improved the quality of life that they kind of like, that they live. And all of those existing institutions have no idea what they're talking about, basically.
Okay. So let me drive it home from a different way. We talked about anonymous money. You probably would be wanting to allow an uncensorable, global, unstoppable, unobservable money. You probably have some similar views that, hey, let's remove the regulation, right? But then you do that. Next, other governments are going to come to you and say that, oh yeah, this is happening. Like, you should really do something about this. Other people in your country are going to come to you to stop you from letting this happen, right? Like there is a pressure that you have to personally and collectively in your small group of leaders somehow. How do you think about this pressure that will inevitably come towards you? Try to change what you're doing.
So I just like, it sounds like trying to like constrain and limit like what we're doing, right? Like we're trying to create better lives for people. And we're trying to increase competition for citizens all around the world so that it also drives their governments to give them better products and services to their sort of like citizenries. We're just like not going to meddle with most things. Like we're building a city somewhere, like we're not going to say anything about money. You know, we're just going to go like, look, okay, we're selling these products and services. You pay us in this currency, which will be probably the legal currency of the host nation, the land that we're sort of like in. and we have nothing else to do with anything kind of like downstream of that. But like there will be situations where we are taking approaches to things like we don't preserve a view because we want to reduce the cost of housing in an area. And then there's a whole bunch of people that are like, oh, that kind of sucks. Well, they can leave,
Yeah.
and that's, I think, or they just don't come in the first place. Right. And I think that's like the ultimate thing that we should be driving here, right? Is that if we can increase the available options of choices that people kind of like have, then they can make a decision which is better for them, of like where they want to go or where they want to be in the product and the house and the infrastructure and the type of governance that suits them kind of like best,
You're still going to run the violence organization of the land, right? So you're not going to let private violence organizations to pop up, right?
I mean, again, like we're going to be building again cities or a city, and so like the effective overall monopoly of violence of that land will still be that of a sovereign nation, sort of like kind of like above us, I mean, again, I don't.
So their police is gonna come in when something happens, and they're gonna make justice.
I think it depends on like exactly what we're talking about and like what stage and what place and all this sort of stuff, right? But it's like there are cities that you can build where you have the authority and the autonomy that you control the police. I mean, that's just like normal in most sort of kind of like cities, that you'll have like the municipal, the city kind of like police, and the city itself funds and controls them and elects them, and they like can do this stuff, right? And so as a city, it's very, very likely that we would also kind of like have that kind of like as well.
Okay.
But then, yes, are we going to have a military? I expect that that's like very unlikely, and therefore that could be, kind of usurped by a host nation if it wanted to be.
You're here. What do you have, and how do you get somewhere from here?
Look, we're looking to like sign a charter agreement with a host nation or host nations that allows us to build a city that will rejuvenate not just their country, but like an entire region of the world. The question is then, okay, well, like what I spend my time doing right now is like, how do we increase the likelihood that we can get a charter, that we can get one that we actually believe in and we want to build and we want to work on, and that if we get it, that we're successful at like implementing the city kind of like beyond that. And everything we do now is about building kind of like up to these things here. It's also like extremely, deliberate, and we're like very agnostic about lots of parts of this. But like right now, okay, so we don't just want to be thinkers or talkers. We want to be doing and learning and building as we kind of like go. And so like we first ran a couple of pop-up cities. First one in Lisbon, next one in Austin. We then also ran a sort of like pop-up city here at Network School as well. We have like a little permanent community here at kind of like Network School. We have some spaces that we kind of like occupy kind of like here at Network kind of like school. And these are all just like mini experiments / like holding grounds / like brand building / like vehicles that allow us to kind of like cement thinking and to be more kind of like sure and considered about kind of like what we're doing. And then I guess like as we look forward, I guess like we are, very interested in a sort of an intermediary phase before we end up with kind of like our final kind of like charter or charters, to basically have, kind of like economic agreements with either, it could be national, but probably more likely kind of like local government, or maybe it's like large kind of like private kind of like developers, where again, we're able to dramatically improve their trajectory, so we can, rejuvenate like, a distressed economy. We can help, turn the kind of like the forecast of a big sort of like development kind of like around. And I guess like how, because I guess like what is ARC doing, and then what we're basically doing, we're in the business of doing, is like pointing at the map and having the world's most important talent, companies, capital, and innovation turn up at that point on the map. And That's very, very powerful. Every single government in the world right now employs 1 to 100,000 people to get those people, those companies, that talent and that capital to come to their country. It's already an extremely competitive market for this stuff. Most are not options, right? Most people don't want to go to most of these places, right? Yeah, everyone is out there trying to get foreign direct investment, trying to get the best people to come and open offices and create jobs for the local economy and to do all this stuff, right? So this is not like a new thing. It's like an existing kind of like world, and we're kind of like just like tapping into that, and we're bringing, I think we're bringing a compelling case of like how we can change the trajectory of whether that's a town, whether that's a city, whether that's a local, a region. So I think we're very interested in sort of like working on an economic level with kind of like multiple parties as our sort of like next kind of like phase, whilst we again continue to just like build relationships towards where we think that we will kind of like finally kind of like build home. It might be several years before we end up with sort of a charter agreement where we have the autonomy to design and build some of the governance systems that we would kind of like to. But I do think that is the greatest value that we can bring to the world. It's very difficult for existing governments to innovate on governance structures, like very, very difficult. If you want to change the US Constitution, you're risking civil war, right? Basically, but if instead you can have like a little sandbox that's able to run governance experiments to de-risk them, prove that they actually work, and then helps you with like a staged rollout back across like existing infrastructure, then like, this can be very, very kind of like valuable for people. But I think governance can be improved like just like unbelievably dramatically. And I think that the benefits of that kind of like downstream are just like so vast, it's basically kind of like unfathomable. And I do think that there will be, several sort of like, kind of like innovation focused cities, which do not exist at the minute, which will be built, over the next 50 years, that will be as familiar names as like Dubai or Singapore are to people today. And if you build those cities will be worth, trillions of dollars to the trillions and trillions of dollars to the regions and to the host nations. And yeah, I think there's going to be multiple of them built by lots of different parties, and I think they're going to provide different sort of experiments and hopefully be extremely valuable to the world. But yeah, it's sort of like a little bit of a path that we're treading, if that makes any sense.
What's one thing you strongly believe to be the case, but very few people agree with you on?
It depends what circles, what circles that you are in. To the average person, I think the vast majority of my views are probably, not sort of like believed. I think the most important one for this topic, right, is that I basically think that we are about to. There are several macro forces on the world that are coming together, which are going to basically change everything. And we are living at a time of history that will only happen once. And I think that you have to be very cautious about trying to learn from history, because things will not happen the way that they have happened before. The analogy I actually give all the time is it's like history is like a kettle, and you've got water in the kettle, and you're boiling that water. And you can look at history and you can just look at this water, and it just like, as you're heating this water up, the water just stays the same. It just looks like water, and then right, it just stays the same. But there is this point, and that point is very soon, where the water that we're boiling goes from 99 to 99.9. Everything is still the same to 99.99. And then in our lives, and I think this is happening in the next couple of decades, we hit 100 degrees, and everything you've seen and learned before is completely fucking irrelevant. We have an entire state change. Suddenly water that was just moving around a little bit faster within a liquid body has escaped and is in a literal new universe and is flying all over the place. And I think we're going through this, like these linear changes, which actually become not just exponential, but it's like they reach a critical threshold on the graph where just like everything changes. And this is happening across a few different kind of like technologies. I think the one that people think about and talk more and is all the rage right now is obviously kind of like AI, which is just technology. But technology is basically, technology has always been like an efficiency benefit, right? Like, whether it's, whether it's language, whether it's, a combine harvester, whether it's, AI talking to you on your thing, like these things exist typically because they are providing either something brand new or they are driving efficiency into an existing system or process, and they are therefore theoretically at least driving the cost of a product or service kind of like down for the same standard of quality, whatever. AI, whether you believe we'll hit AGI or not, doesn't really matter. Whether it's the technology itself is reaching an inflection point where it can basically not just replace human labor, but it can also then perform the new labor that is created on top of that replacement better and faster than humans can. So, I wrote about this, I think, publicly for the first time 8-9 years ago. You can go see, there's a blog from me on this, but it's just like, everyone thinks it's like, look at history. Oh, okay, right. Everyone was using a bison and a plow or a sieve, whatever, and cutting down crops, right? And then instead we brought this machinery in, which lost all their jobs, and they just moved to the factories, and they were doing more higher value kind of jobs in the factories. And then we like automated the factories, and everyone ended up doing in software and all the rest of it, right? And I mean, like, one, if you just interrogate this more deeply, it's just like not true in the first place. It's one quick example. I have family in an old mining town, and since that mine closed, no one has been able to retrain and get new jobs, right? Like, it's just like humans are just like not very good at learning things. But we're now at an inflection point where the speed that AI is able to learn things is faster than the speed that humans are able to learn things, and that we're about to enter the age of true robotics. Where, in the next 5 years, we're going to see full humanoids enter the workforce at a price which is pretty much lower per hour than the lowest kind of like human labor in first world markets. And just like the combination of this stuff is just going to mean that like humans' economic role in the world is going to change pretty dramatically. This efficiency from technology should also be a deflationary force kind of like on the world. It should drive the potential for abundance by the cost of all the products and services that we want falling in price. The challenge that you have, and this is the first challenge for everything that I'm talking about, with governments and with our cities, that all of these places have extreme amounts of debt. And actually, if you imagine a country as a company, basically the vast majority of them in the world are not profitable, they lose money, and they have like almost like negative balance sheets where they have more liabilities than they have assets. And this is sort of like a game that's been being played, but it's a competitive game. And occasionally people fall off and they become a loser, and things kind of like recycle, but the game might just like fundamentally change. These governments, part of the reason they're not worried about the debt that they have is that they inflate that debt away. It doesn't matter that they can't afford to actually, because all they're doing is actually, they're just inflating it away, right? Like there's all this money printing, but simultaneously, if inflation's actually 10-15% each year, the value of the debt that they have to pay back has actually fallen by 10-15% relatively in that sort of like year, right? So like inflationary economies are very, very good if you have a lot of debt, because the value of your debt falls every single year, regardless of you repaying it or not, right? Now, if you truly leverage and implement technology, which you need to win the future, because it's a competitive world, and we have to beat our adversaries if we want to be the ones which are dictating the terms of the game. Even if you want to draw, you have to win to be able to draw, is a phrase I use a lot right now. You have to be on the bleeding edge of technology, and you have to implement it as fast as possible. Doing that causes a deflationary economy. Doing that means you have no hope of repaying your debt, right? That's going to be one kind of like challenge and constraint on that. Simultaneously, what's another force which is happening, right? Something that's maybe closer to some of your previous work. We have alternates to nation state currencies and money for the first real time. I guess that maybe we've had gold for forever, right? But we have this thing called Bitcoin, which is still, who knows? Maybe everyone that's been trying to build Bitcoin over the last 17, 18 years is silly and naive, and it doesn't have the opportunity to actually kind of like replace, kind of like government issued fiat. or maybe it does. One of us is right and one of us is wrong, because certainly governments, I think in adopting and adding Bitcoin to treasuries and in regulating it and bring it out, I don't think they think it's going to be the end of their life. But I do think that trying to keep this sort of like shorter is that like I think the combination of Bitcoin plus US dollar denominated stable coins are going to destroy most emerging market currencies over the next decade. Maybe it takes a little bit longer, 15, 20 years. And then actually what will happen is that, this is like, there's a lot going on here, but we're just going to have to keep sweeping through this stuff. But China will probably resist that by shutting off itself to Bitcoin, and then renminbi will be able to survive in that world, and it'll be a gold-backed renminbi. The US will then have effectively like a Bitcoin-backed sort of like US dollar stablecoin. The question is, will the US dollar also fall? Quite possibly, but there is a need for a stablecoin of some description. Bitcoin is a great medium of exchange, a great sort of like store of value. It's not a good unit of account, and so we're going to need something that performs the function of a unit of account. But where does this all go? Back to the governments and back to our countries, right? Okay, so you can't repay your debt. Okay, so let's print some money, and then I'll just send the money back. Now this is already a problem, and so actually most countries can't actually raise debt in their own currency, because the investors know that the country could just like print its own money to repay that debt, right? Mm-hmm. So most emerging market economies that are not trustworthy like have to raise their money in US dollars, right? And so they can't just print money to kind of like repay it. But this strategy for all the other nations which do that, they raise debt in their own currency and then they can just print more money to pay it off, also does not become a viable strategy if they don't have a currency. And actually they're having to use Bitcoin instead. But like there's a lot there and there's a lot to unpack. But I think the short version is that basically there are new technologies that did not exist before, which are going to make government issued fiat currencies untenable for the vast majority of nations. I think that'll be better for the world in the long term. But I think it will be a challenging kind of like transitionary period. This is going to cripple and just like fatally bankrupt like a lot of nations. And then if you couple that with the pressures on AI as well, this is going to be pretty dramatic. I think there's then like 1/3 kind of like element on this, which is actually probably something closer to sort of like actually kind of like longevity. Is that I am an optimist that in the coming decades, we will be able to dramatically extend kind of like life. But that will, have a cost. And you talked earlier in this conversation about the pressures of the things that citizens demand. And like, so I'm a Brit, right? We come from the UK, and like this, like we have this National Health Service, and like, I'm very grateful for that and what it's done. But like it doesn't work even at the minute, and the country's bankrupt, and it already doesn't work right now, and shit's about to get worse. And so that this model doesn't quite kind of like work, but we're going to have the potential, if you've got the money, to keep people alive for substantially kind of like longer. And at the same time, we will be keeping people alive kind of like older and longer, but that's going to increase kind of like the burdens on infrastructure and on promises that have been made, like pensions. Like you just get a pension for the, there's no money. It doesn't work. But this shit, and so like I think like this other force here of like changing demographics with actually like increased kind of like lifespans, and then a realization that there is like medicine that has a cost but like can't be afforded by these states to people. Like basically, I think like all of this stuff comes together and basically means that the majority of the states that we see in the world right now will not exist in the same way by the time we die. They just be dramatically different. Now, the final point I will say is that I remember being, I ran a company, 10, 12 years ago. And at one point we were in acquisition talks from Deliveroo and Just Eat. It was like food delivery stuff. And I'll tell just the very short version of this. But it's like, I was really sure back then that like Just Eat was like going to die. Right, just that like we had such a superior product on every part, every part of that product. I was just like, there's no way that they survive. And keeping it short, they did, and it was a lesson of how powerful incumbents are. And that's why I say that it's not necessarily that these states will fall and cease to exist, but these states will change dramatically in how they function and the relationships that citizens in those states have, even if they don't cease to exist, because the incumbents just have such power. It is fairly insane. Nation states have exceptional amounts of power. It is kind of like crazy. And particularly if other nation states are not willing to infringe on that, it's insane, right? So this is all context, of why I think that there is, not only there is an opportunity, but the world needs right now different approaches to governance, and I guess to these underlying coordination systems that allow humans to live together in a competitive kind of like world that can survive these changes and bring what, because of these changes, like these should all be optimistic changes, right? Like technology that takes away unnecessary work, Bitcoin that takes away people being like arbitrarily control money, let's just put it that way, us living forever. These are all like should be reasonably positive things, right? And they could be an amazing future, but we are going to need different approaches to governance in different cities and different worlds that can basically take these benefits and have them sort of like manifest in citizens' lives, really. So yeah, I can't remember what question I was answering, but that's like why Arc is skating to this puck here. We are building the product for this world here, and this will be valuable not just to us here, but as an example, as a case study, as a set of open source technologies and processes and systems that like the rest of the world hopefully will be able to copy and to clone and to upgrade their systems and bring them also into what is going to be an absolutely crazy next century.
I hope you succeed. It was a privilege and a pleasure talking to you.
Thank you.
And for the people who sticked around and enjoyed it, congratulations, because this was a really high IQ conversation, So you are something special.
Thank you for coming to the end. And if you want to get involved in this journey, go to thearccity.com, and I'm James of Arc, and find me on Twitter or somewhere like that. But yeah, hopefully you come skate to the puck with us.